In today's video, I am going to discuss about mutual funds. Many American investors often turn to mutual funds to save for retirement and other financial goals. So it is important to understand what mutual funds are, what are their different kinds, and how they work. What are the risks associated with mutual funds, and and what needs to what what needs to be considered while taking decision about selecting a specific mutual fund. Now, before we start with our subject of mutual funds, first I want to write a disclaimer here. This disclaimer is essential to understand that number one, mutual funds are not insured or guaranteed by any government agency, not in USA, not in any country of the world. Even if you buy through a bank and the fund carries the bank's name, you can also lose money investing in mutual funds. So the chances of losing money is always there. No government agency can guarantee that mutual funds cannot cause the loss of money. The second disclaimer is that past performances are not always a reliable indicator of future performance. You cannot predict future on the basis of the past performances. So do not be dazzled by last year's high returns. If you are interested in investing in a mutual fund, you need to understand that the past performance is not an indicator of the future performance, but past performance can help you assess a fund's volatility over time. And the third disclaimer is that all mutual funds have costs. You have to bear some cost when you decide to invest in any mutual fund. So you need to check the different costs associated with different mutual funds. Now let's start our topic of mutual funds. First, we write the definition. What is a mutual fund? Simply, a mutual fund is an investment company which is obviously approved by some Securities and Exchange Commission of that country, especially in America, by the SEC. Investment company that pools money from many investors and invests that money in stocks, bonds, short-term money, market instruments, other securities or assets, or some combination of these investments. This is a simple concept of a mutual fund. It is a simple company which requires investments from many individuals. The people give their money to a mutual fund. What that mutual fund does, it pools that money. It gathers the money from all the investors, then decides to invest in different kinds of investment opportunities available. That may be stocks of a company, that may be bonds issued by some company, that may be short-term money market instruments, other securities, and that mutual fund can also invest in different kinds of investment opportunities to diversify the money of the people. Okay, next thing is that the combined securities and assets the mutual fund owns are known as its portfolio. Okay, now that portfolio, which is managed by an SEC, Securities and Exchange Commission registered investment advisor. Okay, next, what is each mutual fund share? Represents an investor's proportionate ownership of the mutual funds portfolio and the income the portfolio generates. So there are 3 points. Number one, mutual fund is an investment company, okay, which pools the money from many people and then invest in different kinds of securities. The second concept here is that the combined securities are called portfolio, and it is managed by an investment advisor which is duly approved by the Securities and Exchange Commission. The third point is that each mutual fund share contains the proportionate ownership of the mutual fund's portfolio. So these are some points related to the mutual funds for today's video. In the next video, I will continue my discussion related to the mutual funds.